Hello and a very warm welcome to this Insider interview. My name's Dave Baxter and joining me today is Job Curtis, Fund Manager on the City of London Investment Trust. Job, thank you for coming in today.
It's a pleasure.
So UK markets have really roared back to life this year in particular, but the picture is definitely a bit murkier when it comes to the UK economy. Should note that we're recording this before the Bank of England's December interest rate decision. But the last decision, they decided to hold rates at 4%, but they said that they believed UK inflation had peaked. What's your view on the UK economy now?
Yes, so obviously UK economy is important, UK stock market. It's just worth mentioning that actually, if you look at City London's portfolio, it's predominantly UK stock market, some 60% of the underlying sales of our companies come from overseas, and that's typical of the UK stock market. You've got big global companies. But to come to your question on the UK economy, obviously inflation in the UK has been more persistent than in many other countries, but there are signs that it has peaked and is beginning to come back down again. In particular, kind of wage increases have been quite pronounced, particularly with some quite generous public sector increases, last couple of years, and also the living wage, the minimum wage, has kind of gone up well above inflation, and that puts pressure at the lower end of the sort of whole pay structure. So the Bank of England, I think, understandably, is treading quite cautiously because the CPI rate is still well above the 2% target. But I think there are enough signs of a slowdown in the economy, in particular the labour market. Signs of unemployment beginning to tick up a bit and wage increases plateauing. So I would expect interest rates to be on a downward path. They've already fallen to 4% from, I think, 5.25% some 18 months ago. But I think our interest rates are quite elevated still compared to most of the other G7 countries, and I would expect our interest rates to be on a downward path. But the Bank of England, as I say, to tread cautiously. In terms of growth, I mean, we've obviously had much stronger growth in the first half of this year, when actually the UK was, admittedly, it wasn't tough competition, was actually, I think, amongst the fastest growing of the G7. And then we've actually slowed down in the second half of the year. But I think overall, I would expect growth. I mean, obviously we're beholden a bit to sort of the global economy as well. But I would expect overall, growth to carry on at a kind of lowish level. But I don't foresee a recession at the moment. I mean, in particular, the savings ratio is quite high. I mean, if you look at personal savings, is actually that ratio is actually relatively high compared to, and also businesses are in quite a strong. The bit that's in debt is the government, where the public public's obviously got issues, but and I think that's quite a good buffer. I think consumers have been quite cautious, and which means there is something in reserve. So I think when people get a bit more confident, and then maybe when interest rates start to come down, there is scope, for parts of the economy to improve. The housing market is being quite depressed, and yet we know there's quite a latent demand for new homes out there. So I think when people, as interest rates start to kick in, and I think also as bank lending becomes less restrictive, which I think it will do, I think there's scope for the economic growth to pick up a bit from where it is at the moment.
So plenty of sectors very closely associated with the FTSE 100, to give one example, financials, have run really hard this year, delivered some enormous returns. In that context, where are you still finding value?
I actually still think there's a lot of value in the UK banks. I mean, they've had a very good year. We went overweight some 2 years ago, having been underweight since before the financial crisis. But in particular, they benefited from a tailwind from the structural hedge, which are hedges they took out when interest rates were ultra low. And as they roll over after around 5 to 7 years, they're being rolled over at much better interest rates. This is a positive tailwind that's set to persist. But in addition, I think this kind of regulatory climate has changed, and that post the financial crisis, the regulators and politicians were very understandably concerned to make the system safe and the taxpayer not ever to be at risk again. But I think now we've moved on a bit, and I think the issue now is economic growth, and you don't get growth in the economy without the banks lending. And I think so there's much more imperative to actually encourage bank lending, and to make it easier for people to get mortgages, and and that sort of thing does stimulate economic growth. So I think that's quite a sort of positive backdrop for the banks against, a situation where, that the sort of competition in the sector, if anything, has kind of lessened somewhat. For example, Sainsbury's and Tesco's have sold their banking operations to Barclays in that West, and overall, it's quite well disciplined in terms of the sort of competition in the sector, and I think there's quite a scope for the banks to increase their lending profitably. So I would look, when I look at the valuation of the UK banks, so they have re-rated from very cheap valuations. So still, when you look at their kind of profit and dividend potential, I think looking at the relationship with kind of share prices to tangible book values, which is and the returns they make, which is one of the key relationships. I think there is scope. I've seen the bank sector much more highly rated in the past, and I think there's scope for further re-rating.
What's the biggest risk to City of London in 2026?
I think it's sort of global markets. I mean, we are an equity fund, and City of London has a very fairly defensive portfolio, and we're valuation driven and tend to focus on stocks that we think are kind of reasonably rated relative to their prospects and with a firm underpinning from dividend yield. But particularly in the States, there's been this huge boom in stocks associated with artificial intelligence, with absolutely massive valuations, and spending unbelievable sums of money on investing in artificial intelligence, which obviously people have a huge vision about what it can do, but in the short term, are the returns going to really justify the amount of money that is being thrown at it? And these valuations, Nvidia's market capitalization, for example, is worth more than the whole of the UK stock market, even the whole of every single stock in the FTSE 100, Shell, Unilever, all of them added together. And so, if we did see some sort of correction in the States, it would kind of drag back everything, I think, but I would argue that given how much cheaper the UK stock market is, and not just, obviously, that we don't have the same sort of scale of technology companies have in the US, but if you compare our oil companies with American oil companies or our consumer staples with American, we're still on a massive discounted rating, and so I would argue the UK is likely to prove quite defensive in a sell down. But I think that would be my biggest worry, that at some point we get some sort of correction, and people lose a bit of confidence in the kind of huge optimism they've got about the benefits of AI, or kind of in terms of what it will mean for shareholders, at least.
Beyond AI, tariffs have been a major concern for investors, but of course the effects can vary from country to country. What do you think the impact is for the UK, and how does that affect the outlook for different sectors?
Yeah, I take the traditional approach that, tariffs are not good news. They raise prices for consumers, and they kind of lead to inefficiencies. I think as the world benefits from, countries specializing and more trade. But obviously, there's the other arguments that kind of China's abused the system, and there are kind of security considerations as well about certain industries. So, but I think the UK overall, the tariffs apply to manufactured goods. We actually have quite a small manufacturing sector. Our big sector is really services, and that's kind of less. That's not really impacted nearly as much by tariffs. And in addition, UK struck a relatively favourable trade deal with the US, although we're still going to be paying a much higher tariff than we did previously. So I would argue the UK is probably less affected than many other countries. But it's something to watch. Obviously there's a lot of noise, and you get lots of different announcements and changes and kind of positions on one side, and then deals done, and so on and so forth. So it's kind of it's a bit of a moving feast. But I would overall, I have to say, I don't think, in my opinion, tariffs are particularly good news for the global economy. But I think we're learning to live with it.
The trust is very well known for its record of dividend growth, but that growth has not actually been that substantial in recent years. What are you going to do to fix that?
Yes, so the dividend, obviously dividend growth across the market was very impacted by COVID, and in 2020 FTSE 100 dividends went down by 36%, and so that's sort of and a lot of companies, at the time that companies couldn't grow their dividends, partly because their businesses had shut down, or they were issues like the banks weren't allowed to pay dividends, and so there were factors affecting it. And we've had a recovery since then, but we've carried on growing our dividend throughout all of that, helped by the investment trust structure, which allows us to use revenue reserves and carry on growing our dividend in difficult years for dividends. But overall, no, I certainly see in the banks, which we've just been talking about, I do see scope for dividends to carry on growing in that particular sector. I mean, if you look at NatWest, for example, which is a top 10 holding of the City of London, their payout ratio, they paid out 44% of their earnings in dividends last year, and they've targeted 50% this year, but actually, which will lead to fairly decent dividend growth given the earnings going up. But actually, if you look at the history of banks in other jurisdictions, I mean, 50% is actually a relatively low dividend payout ratio. They could actually pay a much higher payout ratio than that. So I think there are pockets of the market, which there are sections of the market which I'm confident about dividend growth. As ever, there are other areas where things are more difficult. And we've had a lot of cuts in the mining sector and also more cyclical sectors, building related companies, and retailers have had to cut their dividends. That's the kind of the benefit of having a portfolio approach. And, by investing in a portfolio like City of London, hopefully I can guide us to the sort of areas of the market where the dividends are growing and mitigate the areas which are, which are more under pressure.
You, like some of your peers, have lamented the fact that institutional investors, so pension funds and the like, have really been steering clear of UK equities in the last couple of decades. What do you think could happen to kind of draw them back in?
Yeah, I mean, what's happened is, first of all, it's a lot of institutions have gone what we call kind of risk averse, and they basically, where they've got liabilities, just want to sort of match them in the least risky way, and they see that as going into fixed interest, just sort of matching their liabilities. I mean, there are periods when fixed interest can be quite risky because of inflation, but nevertheless, that's the course they've taken under kind of advice from actuaries. And in addition, where where people in institutions invest in equities, everyone's gone very global, and the UK is now quite a small part of the. Never was particularly big, but it's kind of even smaller part of the globe, and so they got a lot more money, say, in the American stock market than they will have in the UK market. And to be honest, I don't see anything particularly like to reverse that in the short term. I think it's kind of a bit set in stone. But I think what's happened and what's really encouraging is that the companies have kind of risen to the challenge, and they've seen how undervalued their shares are, and so companies have embarked on a lot of share buybacks across the stock market. And so now slightly over 2% by market cap of the UK stock market has been bought back by companies. So every day at 4:30, I see the announcements of various companies buying back their shares. And this is leading, for the people who remain in UK equities, such as City of London and its shareholders, this is a very virtuous circle, because companies like Shell, give a good example, or Imperial Brands, are buying back substantial amounts of their shares. And so they're able to grow their dividend, but because they're shrinking the number of shares in issue at such a fast rate, the actual cost of the dividend is declining, despite the fact it's being grown. So it's actually, and they obviously, it's very supportive to the share price. So I think this is one of the reasons why the UK stock market has been performing very well this year, and rather better than the American stock market, is that I think this share buyback, which is bigger as a proportion of its market cap than the US share buyback, and we've got a much better dividend yield. And I think so the companies have risen to the challenge. So I'm not, I think for the UK institutions to, come back to the UK, it's a bit like waiting for Godot, and I'm not kind of, I'm not sort of getting too excited about that possibility, but I think the share buyback is making up for that.
What are your biggest reasons to be cheerful and to be fearful in 2026?
Well, I think the valuation of the UK stock market is very supportive. It still is the cheapest rated on our calculations of the major stock markets, and it's somewhat below its kind of long-term average, unlike most of the other stock markets. And you're being paid by your weight. You've got a dividend yield of over 3%, around 3.3, a share buyback going on around 2.2. So you've got what we call a total distribution yield of about 5.5%, which I think is a very strong starting point. So you're kind of paid to hang on in the UK stock market, is one way of describing it. Whilst I think in terms of my worries, I guess the geopolitical, you can't sort of worry about it every minute of the day, but we've still got a war going on in Ukraine, and obviously still got these big tensions with China, and obviously issues in the Middle East haven't gone away either, really. So I think the geopolitical, could rear its ugly head at some point, but I'm not predicting it will. But I think it's something you can't kind of ignore at all.
Job, thank you for your time.
It's a pleasure.
So that's it from us. Many thanks for watching. Do let us know what you think in the comments. And if you enjoyed this series, do hit the like button and hit the subscribe button. Take care.